Good morning, everybody. I'm very pleased to be here today. I would like to thank InnoEnergy for the invitation. That's a company with a truly European DNA. I guess that most of you have read the 400 pages of the Draghi report, right? If you didn't, I can summarize it in one sentence, which that Europe has to invest 800 billion euros per year in the next 5 years for innovation-driven, high-risk projects. So that's a lot of money to many. That's probably why that has such a little scarce follow-up. So we know what must be done, but the real question is, as always, can we do that at scale and fast enough? So I'd like to share with you 5 ideas that are drawn from the French experience, which is known as the TB initiative, and why I believe Europe can build on it. So to explain what the TB initiative is, we thought that in our country, in France, because of budget constraints, public money could not fill all the gaps. So we need to mobilize private capital. And also that we needed to focus on equity, which is really the scarce part of the balance sheet, because debt, for good and bad reasons, is relatively available. So we started 7 years ago, and we convinced 37 institutional investors, long-term investors, to commit 13 billion to tech funds, venture, growth, and listed tech. Most of these investors, insurance companies, 2 trillion in France, family offices, even a few pension funds, had never invested in venture capital, nor had direct exposure to technology stocks. We spent a year explaining the financial opportunity, the logic of diversification. We looked obviously at the global benchmark, US of course, but also China, and also smaller countries like Sweden and Israel. Eventually, 21 LPs pledged 6 billion in the first phase of the plan, and then 16 others joined 3 years later that expanded both the commitments and the confidence. I want to stress that there were no incentives, no carrots, and no stick, no obligations. We've worked on the alignment of interests and a clear financial story. So it was really legwork, a lot of legwork, not a cavalry charge. And it worked. So the first idea I want to share is that Europe has to operate at scale. It is not a choice, it's an obligation. The reason is that our competitors, the US and China, they are continents. They are very aggressive. Their industrial policies will weaken us if we stay fragmented. And I think this is also the purpose of their industrial policies. So scaling up means that we must allocate to our best project the access to all European capital pools, not just national ones. This is essential for tech, which is a global technology. And this is even more essential for energy tech, which depends on industrial infrastructure and cross-border transnational networks that precisely deliver that scale. So if you want European champions, we must give them European scale financing. The second idea, that the semi-good news, is that Europe has the money, but it doesn't have a fully fledged mechanism. We have the money because there are 35 trillion euros in households' private savings. So if you compare that to the 4 trillion, It is not ridiculous. And that would change the game. So it's 10%. Allocating 10% of that would change the game. So the question is not the existence of money, it is the availability. So we have savings, but we need to turn savings into capital. And that's, as you know, it's pretty different. This means creating the conditions for investors to take risk, fund innovation, and make them feel confident they are protected by sound governance and policy clarity. So the third idea is that we need to reinforce our ecosystem of long-term investors and VCs. We need long-term investors who see risk not as danger, but as diversification. And we need competent fund managers that are able to deploy capital wisely. In Europe, we have a foundation, a relatively small but capable base of funds that can evaluate projects, analyze their leadership and technology, design structures that match the risk-return profiles of each investor. The real bottleneck is the reluctance of institutional investors to allocate capital to these funds. And I think there are three main reasons that we must really have in mind. The first one is the shortage of pension funds in Europe. But even that, we see that even in the UK, 3 trillion, in the Netherlands, 1.5 trillion, we see that pension funds are very reluctant to allocate funds to risk and technology. So the second reason, and the third, I think, tell the story more. First, it's a groupthink, a behavioral inertia. Bonds have been so profitable in the last 40 years of decrease of interest rates that few saw a reason to move. And when LPs don't know an asset class, they don't invest. And when they don't invest, they don't know the asset class. And the cycle repeats. The third reason is carrier risk. So you may say, okay, that's very vulgar to look at the incentives of individual people, but individual people take the decision. So the third reason is carrier risk. In the LP community, no one likes to take one risk alone. If an investment fails, carriers end. So the environment becomes mimetic. I believe that in France, we broke that cycle with a simple recipe: a strong political leadership. The President of the Republic wanted results and said it explicitly. Then a collective project under LP governance, no government control. And third, transparent exposure of funds and projects to investors. The key word there is governance. Once the structure is trusted, LP play the game. And actually, they invested more than they initially promised. That's an important lesson for Europe. We need to build trust, not mandates. We must encourage desire, not compulsion. My fourth idea is to develop on these requirements on political leadership, industrial policy, and governance. Strong political capital is indispensable to attract private capital. LPs operate in regulated sectors. They listen to signal from the top. Do we have that at the European level? The muted reaction or reception of the Draghi report gives us part of the answer. Europe's fragmentation is not only geographic, it is institutional. Within the Commission, our topics are spread across multiple commissioners, directorates general, and schemes, each with its own agenda. I don't criticize this in isolation, but the common picture is a bit blurred. That's not how you project a unified, credible political message that inspires investors. So we need also, in addition to strengthen the leadership and make it much more visible, we need a clear industrial policy. In Europe, industrial policy is a dirty word because it evokes crony capitalism, governments favoring the best connected players regardless of competition. We can do better. The United States, this very liberal country, has an industrial policy, and a very tough one. Obviously, China has an industrial policy that has been very effective. So there is much talk about strategic autonomy in Europe. Now it's time to walk the talk. And no European sovereignty without an explicit plan to focus on future sectors and to protect European operators. To avoid cronyism, we must have strong and respected governance. The US system shows the way. I don't say it's perfect, but it's a very good example. A legal framework that supports industrial policies, agencies that select the best projects and sectors, and a predictable environment that allows investors to act with confidence. I'm not talking about President Trump. I'm talking about the system. And we need something equivalent. The European version of DARPA focused on high-impact innovation. The 5 ideas, I told you it needs to be private because public money is too small in the current context. However, public money is indispensable, and I think it's been well exemplified by Elina's talk. We cannot expect private investors to do what they cannot do by rule. Finance projects with distant returns beyond 10 or 12 years, or prototypes, untested technologies, or first-of-a-kind industrial prototypes. Public capital must play its role, de-risking projects so that private capital can follow. That can mean subsidies, guarantees, co-investments, or long-term off-take agreements. It is very legitimate, in my view, when projects serve the public interest. And that's precisely the case for energy, obviously, but also for defense and deep tech in general. Yet, fiscal constraints are very real, but the market, the financial market, the bond market reacts very differently when debt finances value-created projects rather than current expenditure. Borrowing to invest in growth is not the same as borrowing to invest in consumption or pensions. So my final message is to develop a bottom-up ambition. Some of the ideas that we tested in France at small scale can work in Europe, provided that they are matched by bold political initiatives. And frankly, we have no choice. But my message to industrial leaders is the following. Don't wait for a perfectly designed public program. It did not work fully before. It will not work now or in the future. Instead, or in conjunction with what exists, build fully fledged solutions from the bottom up. Form coalitions. Propose operating models to the governments. Ask them to connect across borders, to move not only at the EU level, but also at the intergovernmental level, because it can work much faster. You don't need to align 27 countries. It's hard, it takes persistence, but what else? So Europe has the capital, the talent, and the technology. What we need is confidence, coordination, and courage. If we align political will, public funding, private ambition, we can close the growth financing gap and turn Europe's savings into Europe's future. Thank you very much.
Thank you so much, Philippe Tibi. Thank you for your keynote address. Thank you so much.